Hey everybody, how you doing? This is Byron of Byron Riley CPA, and one of the things I want to talk about real quick. I was going to jump on a conference call, and one of the things I noticed in the headlines the past few days was a major topic of: Are you paying more in taxes this year? Better yet, why don't we pose a question: Where did my refund go? And with the new tax law, some people are thinking they're paying less in taxes. Some people think they're paying more in taxes. I will tell you this: there are definitely winners and losers. But however, it's not in general terms because a tax return is kind of like a fingerprint. It's uniquely different for each person. However, there is a way for you as an individual or as a business owner to better go and compare whether or not you are paying more in taxes versus last year. And so there's a few things you should better look at. And so one of the things I did was I put up I'll put on the screen here a simple return comparing a 17, 18. Of course, these are imaginary numbers, but just to give you an idea on how you want to be able to compare and contrast your tax return. What should you be looking at? Let's say all things remain the same. There was no change from last year to this year. All right. And so this way we can do a comparison. How does the tax change impact your tax return? So here we have a married filing jointly return and Schedule C filer as well as with a W-2. And so we look at the first line, adjusted income, that remained the same. And so now we come down to whether or not did they itemize or did they take the standard deduction. And so last year they did the standard deduction, 12.7. This year, the standard deduction increased, 24,000. Now, if you have more than 24,000 in itemizable expenses, then you would definitely take, you would itemize. But in this case, we're just using standard deduction. One noticeable difference here, they had two dependents. And so this year, there are no personal exemptions at all. Whether you have 2 kids, 5 kids, 4 kids, you are not getting a personal exemption. You and your wife would only be getting the standard deduction. In this case, this is definitely a place where you can compare and contrast between last year, because if you see right here where you had 4 personal exemptions, those are now gone. You only get the standard amount. So whereas last year this family had 28,700 or 28,000, what's that, 29,000? Oh yeah, right, 28.9 and between itemized and exemptions. Now it's only 24,000. But the flip side is that this person had a Schedule C and they picked up the QBI deduction. All right. And so just for here, I just did a standard 20% deduction based on net business income for a Schedule C filer. Here we look at taxable income. Because they picked up the qualified QBI, qualified business deduction, well, once again, that reduced the taxable income. And so, yeah, they might have missed out here on the exemption, but they picked up a little bigger deduction on the QBI. All right. And so now we look at what is the actual tax, 14,000 versus 9,000. All right. And so we go down and we look at actual payments made. We said, okay, so here's where a lot of people are falling into the trap. Your payments remain the same. And so now you might be bringing more money home or maybe bringing less money home. And so that's going to impact what is owed. They picked up a penalty. Well, last year they picked up a penalty because they didn't pay enough in, picked up the same penalty, they didn't pay enough in. And so we look at the amount owed, 16,000 versus 21,000. And this is how you really measure your, are you paying more or less in taxes? All right. So one of the things you want to look at, what is that effective rate? All right. That effective rate being right at 11.9% versus 8.3%. Now, also notice too, because of the lower income, net income, the tax bracket was lowered, 22% versus 25%. So overall, this person actually benefited better under the new tax bill. Like I said, there are cases where people are going to pay more. And so it's really case by case. You definitely want to take a look at that and see how it's going to impact your taxes. You got to do a year-over-year comparison. It is not a one-stop, a one-shoe-fits-all. And so you really have to look at your numbers and compare year over year. You know, you got to look at major events. Did the business income grow? You know, but one definitely good comparison to do is total income effective rate of your taxes versus the effective rate last year. So if income went up, say additional 20,000, yeah, you're gonna pay a little bit more in taxes. But if your effective rate last year was say 15%, and now you got it down to 10%, your percentage of taxes per dollar is less. So this is just a quick overview on how you need to look at comparing your taxes year over year. All right, hopefully you find this helpful. Reach out to me. I'm Byron at ByronRileyCPA.com. You can give me a call, 832-303-3995, and I look forward to hearing from you. Have a blessed day.